Hey there, accounting fans, and we're back for another The Comic Accountant podcast. And joining me here today is Dave Tyrer, Chief Operating Officer of Squirrel Investments. Squirrel Investments is New Zealand's leading, well, only actually, peer-to-peer lending platform. And he's here today to talk a little bit about what peer-to-peer lending is and if investing in peer-to-peer lending is a good idea for you. So let's give a warm welcome to Dave. Hi, Dave. How are you?
G'day, Sam. Good to see you, and thanks for having me along today.
Hey, not at all a problem. Not at all a problem. Thank you so much for joining us on our podcast here today, Dave. So, Dave, would you care to introduce yourself?
Sure. So my name is Dave Tyrer. I work for a company called Squirrel. Squirrel is a company. We've been around since 2008, started by our founder, John Bolton. So JB, as he's commonly known, started the business as a mortgage broking business. And that mortgage broking side of our business has now grown to have 50-something people in that part of our business. And we're going to settle probably about $2 billion worth of home loans this financial year. And then he's quite an innovative sort of a character. And so when the peer-to-peer legislation was introduced around 2014, 2015, he decided to jump on that and launched a peer-to-peer lending and investment business. So yeah, that launched 6 years ago this month, as a matter of fact.
Wow.
So yeah, there's a number of people obviously employed in that side of our business, and yeah, the wider Squirrel business, we're based in Auckland, but we've now got people based in a number of different cities around New Zealand. And yeah, we really enjoy helping New Zealand homeowners. That's what we're all about.
I think that's really, really awesome as well, because I think it is really the great struggle for a lot of people of my generation, especially wanting to get into their first home. Me and my wife are also looking to get into our first home by next year, hopefully, fingers crossed. But we're not really here to talk about home loans. Rather, we're really here to talk about the investing side of peer-to-peer lending. So before we get into that, really, could you explain to all of us what is peer-to-peer lending in a nutshell?
There you go. I like the term nutshell. Fits very nicely with the Squirrel brand.
So all right, because it's a squirrel, right?
Well,
you've got your ducks all stored away. Totally unintentional pun. Very unintentional.
Sure it was. Sure it was. So to answer your question, Sam, I guess there's no such thing, the old adage of there's no such thing as a new idea. And the concept of peer-to-peer has actually been around for a long time. And if for perhaps some of the listeners, you may remember contributory mortgage schemes that were often run by solicitors and accountants, where they'd have a pool of people that had some money to invest, and they would sort out a mortgage-backed loan for those investors to invest in. And that was really common in New Zealand if you go back into particularly the 1970s and into the 1980s. And that concept or that idea has been around in the world for a long, long time. It's not a recent phenomenon at all.
That's interesting.
I guess the more recent take on it, though, is there's a company called Rate Setter in the UK who started a peer-to-peer digital lending and investment platform in the early 2000s, so about 2004, I think it was. And I guess that's the beginning of this next wave. You call it peer-to-peer 2.0, perhaps, that started at that point. And so over time, a regulatory regime has been built up around peer-to-peer and rolled out in quite a large number of countries right around the world. So New Zealand's legislation came into being in 2015, mid-2015. So that's kind of a bit of a history of peer-to-peer.
I had no idea it's been around for that long.
Yeah, so perhaps the old style or 1.0 peer-to-peer has been around for a long time in New Zealand, but the 2.0 version's really only been around for about 6 years in that sense. So maybe what I haven't done yet is describe what peer-to-peer actually is. So maybe I better do that.
Yeah.
So peer-to-peer is all about helping investors to invest directly into a loan via a marketplace. It could be on a one-to-one basis. So you've got one investor who's got $1 million and is lending $1 million to one borrower. Or what is much more common is it's a fractional investment. So that means you may have many investors, each investing, let's say, $50,000 each, and they are collectively going to lend $1 million to a borrower who needs to borrow $1 million. I'm just using those as round numbers to keep life easy for me. So yeah, either it can be on a one-to-one basis or it could be on a fractional basis. And most commonly it's on a fractional basis. So the marketplace in many respects is no different to any other financial marketplace like the NZX, for example. So through, if you're an investor and you go to the NZX, you can invest in shares or you can invest in bonds. And when you arrive to Squirrel, you can invest in loans. It's kind of the difference there. And there's a number of peer-to-peer lenders in New Zealand, so Squirrel's not the only one. Some people might be familiar with Harmony, who are a peer-to-peer lender going back in time. They're still a lender today, but they have stopped supporting retail investors. And there's about another 5 or 6 peer-to-peer companies in New Zealand.
Oh, I guess I was mistaken in saying that Squirrel's the only one left.
Yeah.
Yeah.
Definitely not the only one left.
Oh gosh. All right. Well, I better be corrected on record then. And so I think the really interesting thing about peer-to-peer lending, it actually gives the retail investor options, right? When they're looking at how they want to diversify their investment portfolio. Instead of putting all their money in term deposits and stocks and shares, or even on a rental property, you could even consider putting your money in a peer-to-peer lending platform, right? But on a risk versus return scale, where would you rank peer-to-peer lending investment?
I guess there's a few things to think about, and there's not just kind of one risk that you can concentrate on here. There's a few different types of risks. So probably the first thing that you'd think about is, who am I going to be lending this money via, or who am I investing with? And so you really want to think about the who that organization is. So if you go and invest with a bank, then you would know that a bank, in order to use the term bank, they have to be regulated by the Reserve Bank of New Zealand. Yeah. So you've got a pretty big regulator there, making sure that banks do, follow certain rules and do the right things. If you invest via the NZX into shares, for example, then the NZX is there effectively looking at how people invest and making sure companies provide certain disclosure and transparency around what they're doing and those sorts of things. And if you were going to invest in shares, you'd think about who is this company and who are the people behind it? Are they
true.
Good citizens, shall we say? And do you trust them?
Yeah.
And I would say those sorts of questions that you're going to ask, you should ask of any investment that you're going to make. So whether you're investing into a managed fund, whether you're investing into shares, whether you're putting money into term deposit, who am I investing with? And what is their role in that investment? So from a peer-to-peer perspective, I'd encourage anyone who's thinking about peer-to-peer to make sure the company that they're investigating is registered with the FMA and they have their license from the FMA. Or the Financial Markets Authority. So you can go to the Financial Markets Authority and find that information on their website. So Squirrel, we're a licensed peer-to-peer operator in New Zealand. So I've been investigating that. Second thing is I'd look at the people. So who are the people behind this and what can you find out about them? And make sure that you're dealing with trustworthy people ultimately. And I think if you reflect back through the GFC in New Zealand and the finance companies that went under during that period, they really did tarnish parts of the industry in New Zealand. So, I think there is people who are a bit gun shy or were burnt through that period with finance companies. And so you really want to investigate who are the people. And, I'd happily say I'm happy for you to investigate anyone at Squirrel, certainly anyone in our independent board of directors and in our senior management team. And I think you'll find that we're good citizens. So that's one thing. So who am I investing with? I'd have a think about that. Make sure they're licensed in some way, whether it's by the FMA or by the RBNZ.
Yep.
And then the second thing is for peer-to-peer. Typically, peer-to-peer is about investors investing into loans or into debt. If that makes sense. So what sort of debt is it that you're investing into? Right. So that's your second question. And that all comes down to credit risk. Okay. So I'll explain or expand on that slightly. Credit risk is different for a property developer compared to a homeowner. So homeowners tend to pay their bills and you see very few UG auctions in the scheme of the size of the New Zealand property market.
Right.
But you hear about property developers falling over on I won't say a regular basis, but you do hear about them from time to time, right?
A little bit more frequent than your average homeowner, right? Yeah.
That's right. And so what I'm describing there is credit risk, right? So at one end of the scale, you've got a property developer who's taking on generally quite high risks, I'm generalizing, versus lending to, a family to buy their first home or their subsequent home. The credit risks are very different. And that's why in the market, a property developer tends to pay higher interest rates than the person who's buying their first home, who tends to pay lower interest rates. Yeah. So the interest rates give you an indication of the type of credit risk that you're taking, and it sits on a scale. So understanding your credit risk, I think, is quite important. And then probably the third thing you want to investigate is, well, what are the investment options that are available? How long is my money going to be in this investment for? Is there liquidity? And when I say liquidity, does that mean you can trade your investment in and get your cash back before the end of the loan? Is there, does the provider provide any way of helping you manage credit risk? What services do they provide? What happens if a loan goes bad? So there's some investigation into things like that. But I think that, if I pull that back to the overall risk return scale, credit risk, when we're thinking about peer-to-peer lending, credit risk is the key one. So how much risk am I prepared to take? And, another analogy for that might be if you're investing into managed funds, are you going into a high-risk managed fund or are you going into a conservative managed fund? And the returns are likely to be different between those things. Certainly the volatility in those returns.
Certainly the whole risk return trade-off works the same as well, where if you take on a high risk, you're generally going to expect a higher return.
That's right.
Yeah. All right.
Yeah. So I think those are the risks that I'd think about. One, who is it that you are investing with? So investigate the company, make sure they're regulated and licensed. And the second one would be think about credit risk.
All right. Thanks for tuning in to our podcast on P2P investing basics. Join us next time with Dave as we learn more about what happens when you invest in a P2P platform. Until next time, stay positive.